Hi, everybody. This is Maliha Bengali at MBA Commodity Corner. We thought we'd take a little bit of time today to actually talk about some markets or some key charts. This is the first video we're putting out on YouTube to our clients and to hopefully new subscribers to just run through what the market's thinking and tell you a little bit about how we sort of look at markets. So MBCC really is a gross asset relative value fund that actually we look at commodities not only from a bottoms of physical demand supply perspective, looking at inventory balances, demand supply, but we also look at it from a top down perspective because we know that commodities cannot be looked at in isolation. There's no more those days of just looking at physical loadings and demand supply. That is not what dictates commodity markets. Macro is very important: dollar, interest rate policy, credit, liquidity. So we look at a host of 25 different factors and to quantify basically all the cross asset discrepancies and then sort of pinpoint is to figure out what actually is mispriced and how we can actually trade out on that. A lot of people look at the physical markets, can talk about how, inventories are the most important thing, but then on the macro, people talk about the dollar, but it really doesn't work that way. And you need to look at both rather than just one. We look at a lot of things to actually look at how things are mispriced. And we know that each asset class usually has a bit of a time lag in terms of how it prices in a certain theme. So today, the goal is to go through a few charts and tell you exactly what the theme is that the market's pricing in and where we see a massive opportunity into March. The chart you see in front of you right now, I'm just going to close my screen here a bit. The chart we see right now in front of you is the S&P 500. Obviously, we've seen the market rally from October of last year, it's up 20%. And from 2022, it's up about 40%. And the market really has been up in a straight line all the way since then. We've had a lot of talk about 2023 and really what has, that means. The Fed's been talking about quantitative tightening, but in fact, it actually has been injecting liquidity in, hand over fist in all of 2023. We had the US regional bank crisis where they had the BTFP program, where they injected liquidity to save the banks from going completely bankrupt. And then we saw a massive surge in liquidity. So on the one hand, the Fed balance sheet has been going down, but if you look at all these backdoor liquidity injections, liquidity has been picking up, and that's fueled this rally along with passive money. Every right now is long the S&P right now, CTAs, long only institutions, retail, FOMO. And the problem is the S&P really is not indicative, it's not representative of the economy as a whole, and we know that, right? So last year, maybe we had 10, 12 names driving the market higher, the Magnificent Seven. Today, we actually have probably 4 or 5 names, and now it's come down to 1 or 2. So even Apple and Google are losing their charm right now in the index, and Nvidia and SMCI and AMD are probably the only names taking it higher. So the S&P really has become a one-way bet on AI. Taking a step back, we believe in AI, but our job here is not to talk about AI. We believe in the future prospects, but our only issue is valuation and timing. Timing is everything. Today, if you're pricing in the 5 forward years of earnings today, what are you investing for? What is the bet on? If everybody's all in and you price in maximum multiple expansion, can you really, really have a good risk reward bet? Not really, right? So the S&P right now, as you can see, we've made new highs in the 5120 mark and we move back down here. There will be a big important test as to whether we break this and go back down. Our view is that we saw March is a very important month, and we actually think because of liquidity getting out of the system, Yellen and Powell have sort of drained all the resources, and right now the data is so sticky that the Fed has no choice. It cannot cut right now. The market came in this year pricing in 7 cuts. It's now pricing in about 3. The Fed's actually turned around massive in December talking about rate cuts when really it cannot cut rates because on the one hand, financial conditions have eased so much, but on the other hand, inflation is very sticky. So if they've cut today to save the market or the consumer or the banking system, they're going to risk inflation going back to 4%, 5%, and they can't afford that. So the big thing here really is, do we sort of hold here or do we sort of go back lower down? And March, we have the FOMC meeting, we have a host of indicators, and our mantra has always been that liquidity has been the driving force in a lot of sort of the asset classes. So that's the S&P right now. Taking a look at the NASDAQ, we see the sort of similar thing happening, right? The NASDAQ has had a massive rally. We're above the 2022 highs. We've had all the way down in 2021. And the reason why we fell in 2022 is because the Fed went on a massive rate rising campaign. They raised rates about 550 basis points. And, technology is a long duration asset. When you raise the interest rate, the discount value, the intrinsic value actually goes down. So as much as we like to talk about earnings and stories, QE and liquidity has played a big role in the tech rally. Take a look at ARKW and all the other sort of non-profitable tech companies. They have not rallied because QE sort of ended this, liquidity is being drained out. But then this year, the market's been sort of playing the AI rush. And the way sort of, US bond yields have been trading, US tech stocks have actually broken away from that correlation altogether. They should actually be down given the higher for longer rates and yields right now. So market's been obviously playing the micro story on the AI enhancement, and, earnings have been going up at 25, 50% plus in some names. But taking a step back today, people compare the tech market today to the .com and saying, hang on, today we only had 40 times at the tech, the .com, we were at 80 times or 60 times. So we're not a bull market, but it doesn't work that way. Every bubble has its own metrics, and we have to be important to actually talk about that rather than sort of use it sort of, very sort of blatantly. The tech right now, we're seeing sort of weakness today. We can see we're sort of threatening the 21-day moving average. Technology stocks have been losing its momentum, is going higher and higher and higher on declining and RSI divergence, which is really not a good sign. Everybody's all in. So the question is, who is really the marginal buyer? The Fed's going to have a big meeting in March. And if they actually talk about how they're not going to be dovish and not cut rates because the data has been coming in stronger than expected with prices paid a lot higher, that's going to take, the sort of the steam out of the market, and dollar could rally. Also, the other thing is the bond market. The bond market is one of the most smartest asset classes out there, and it's been signaling distress for quite a few months now. And we trust that, because the bond market is not only the price of the bond yield, but it's the shape of the bond yield curve, right? And we have a massive inversion, but it's not about the inversion per se. It's about when the bond curve uninverts is when it starts getting troublesome. And the bond market has been calling the Fed out, saying that it's lost control of its narrative. And we believe that, because the 2-year yield is going to fall a lot faster than 10-year. And as the curve uninverts, we're already in a recession right now. For instance, the whole world, the UK, Japan, QE, Europe and China, a massive recession right now, but US is the only one sort of holding, and everyone right now today is like, right, so the S&P is up, so everything else should be up. No, it doesn't work that way, because all our demand metrics we look at across the board are showing weakness in the physical markets, and the physical markets tells you what's really happening in the economy. So the market is not the economy. And yes, today the big debate is, should we go long, value versus short growth? And this is a trade of the decade, right? When is the right time to go short growth and long value? And people are going the hand burn, but we always say you can't look at it from a relative perspective. You have to take a look at it from two different perspectives. The question today should be, should I be long or short tech? And the other question should be, should I be long or short commodities? We see pockets of value, but it's a very, very different sort of segment, because commodities are run by physical inventory balances. And we'll spend a little bit of time talking about oil. Oil is obviously one of our biggest parts of our business. And as most of our readers and subscribers know, we've been very sort of bearish on oil all for the last 2 years. And no matter how much OPEC Plus has been cutting production, they just haven't got the demand right. The demand has been very aggressive. They were pricing about 6 million barrels per day upside, but demand's becoming a lot lower. Saudi Arabia today is trying really hard to keep prices above 85, 90, because they've spent way too much and they've got vested interests. They are not today who they were 4 years ago, so they can't afford a price war. They can't really talk about flooding the market, getting market share, because they're really, quite delicate here in terms of wanting a higher oil price. As you can see the charts here, the Brent oil market looks a bit supportive here. It's been sort of trending high all of this year because of this OPEC tightening, but demand's not played ball. We just had this sort of, Q1 winter demand, where usually winter's been warmer than average. We haven't been drawing down the inventories that much. But the thing we like to talk about is that most people look at oil, talk about geopolitics, OPEC plus, they talk about, wars and stuff. These things really don't drive oil. The thing that really drives the oil market is the product markets: distillate, gasoline, naphtha, jet fuel, cracks. And the average oil trader who looks at these charts or looks at those markets won't know the crack spreads are trading at. So commodity markets are not tech stocks. You can't just look at the charts and make money. Yes, charts help you because momentum is important, but end of the day, physical market balances drive and dictate commodity prices, and macro and micro is very important. And that's why we actually see an opportunity to actually trade those dislocations right now. So in this chart right now, you can see that Brent oil price is looking very supportive, but commodities trade in cycles. And right now we're just sort of entering a shoulder week period where oil prices actually fall because the demand's not there. We're just exiting winter and entering summer, but we were way too early to play the summer trade right now. And, commodities move in cycles, and you got to play that, and timing is everything. Being long any commodity and riding for 4 years is not the same thing as, sort of timing it, because you could get, call the top and lose 20%. Making money today, 20%, losing it is not the same thing as making it when you sort of buy on the lows, right? So timing is everything. And we know how equity analysts talk about, these sort of stale buys and stale sells. They're not running money. So they, for them to make a call, it's easy to be right, but running risk, as we know, is very different. So the Brent oil market right now, we sort of take a look at that, but take a look at what we're looking at something else, the heating oil market. The distillate market, the heating oil market, has actually been quite weak, and we can see how it's sort of lowing down, and cracks actually have been falling. And that's the reason why the oil market is actually not holding up that well. So yes, you can argue about the oil market getting tighter, but demand has been really soggy, right? We spend a lot of our time looking at future cross asset loading. So we look at like 6 weeks physical loadings as to what's being priced in, and then sort of pinpoint as to what price will do. So today the oil market is already pricing in the physical loading 6 weeks from now. So it's very important to take a look at that, and we can tell you what the trade is going to be in oil. So today we would, oil is cheap, but in the saying in our industry goes, cheap can always get cheaper. Timing is everything. We do like oil at some point, but demand in China has been very bad. We think the economy is on the verge of a global recession. Not a single analyst today is calling about a recession, because everybody was so wrong last year calling for a recession, that this year everybody's on the no landing, immaculate disinflation. We'll tell you one thing, the Fed got very lucky because China imploded at the right time, and that sort of goods deflation sort of went to the US and helped the Fed fight against inflation. But the sticky parts of the economy, like services, housing, rents, those things have really not helped the Fed, and service inflation is keeping the average CPI, core CPI rate a lot higher for longer. And I think the market right now is pricing in this massive slowdown because of Biden fiscal spending. There's been massive amounts of fiscal boost that's actually helped the consumer, and the market's up for a lot longer, but we're seeing cracks in the system. The US consumers tapped out. They're strained. They've used all their credit right now. The real wages are not keeping up with personal income, with inflation, so they can't really afford the same things anymore. The housing market, CRE market, we talk about how that's not an issue anymore, but banks are not lending out because they had to refinance, and the refinancing this year means they can't actually lend more out. So there's so many different pockets of weakness. People look at the S&P 500 and talk about how we're in a bull market, but if you take those 7 stocks out of the index and look at the earnings of the remaining 493, earnings are down 3%. So we really are not in a bull market. And I think it's important to look at how the top-down story plays in with, the bottoms-up story in commodities. The next chart we like to talk about is Bitcoin. And obviously this has been sort of all the rage in the markets. We've seen Bitcoins rally from all the way to 69,000, hitting the all-time high from 2022. Let's not forget, a lot of people have been long Bitcoin since then, calling for 500,000 or 1 million. So today they're just in the money after 3 years. And there's a lot of pressure here. This has been sort of very well timed with the halving event in April. We have the BlackRock ETF, the Vanguard ETF being launched, a lot of inflows coming in, sort of taking the market higher. The question today is, people talk about Bitcoin as a source of value. It really is not a store of value. It's a great asset. It's speculative. It's going to be here for longer. You can trade. There's great trading opportunities. But let's not mistake ourselves. You can't actually talk about Bitcoin being a source of value. Gold is a store of value, right? So take a look at the gold price today. It's been rallying for the last few days, and it's people saying, oh, it's catching up to Bitcoin. No, the bond market and the gold market have been talking about something that's the equity market has no idea. They are distress signals, it's risk-off signals. And I think Bitcoin right now, you see that today we touched the all-time high, and boom, we went right back down to 62. It's actually down 7% on the day. So if it really was all about the Fed cutting rates or the recession, the economy going to recession, would Bitcoin be selling off? If equity markets fall down, Bitcoin falls. It's a liquidity drive, right? So you need to differentiate what are we trading and why are we trading in, and the narratives can get really confusing when people take a look at the price performance. And I think that's the thing that we need to we spend a lot of our time looking at the fundamentals, demand, supply, the flow, the top down, and sort of pinpoint and sort of time our trades correctly. Near term, we obviously bearish on Bitcoin. We think we can see it falling back down here before the halving event in April. There's a great long-term story, but timing is everything. And people buying, the AMD, NVIDIA, and Bitcoin today are sort of late to the party. And I think March is going to be a very tricky time. And that's what we talk about in our video today. We hope you love the video. We think March is going to be very exciting, and everybody's long right now, but there are a lot of catalysts on the macro side. Everybody talks about how macro is dead. Macro is dead until it isn't, but, we have to respect all of that. And the equity market bulls who are bullish right now, that their arguments have been completely baseless in the sense that, yeah, they're lucky because the market's been moving up in a straight line, and over the 10-year period, you're usually right. So, but that doesn't mean you can actually be right making money, because if you get the top or the bottom wrong, you can really lose out. And people who talk about this earnings stories don't even address the debt issue. The US is on an unsustainable debt path. Today, we're printing $2.50 just to get $1 of growth. We're borrowing from future growth. There is no GDP growth. Bidenomics has made the whole thing worse by we cannot grow without printing more money. And today, where are they going to print? the Treasury and Powell right now have completely, usurped their resources right now. And if they were to cut rates today, inflation would be a massive problem. So Bidenomics has taken up where we are, but today the U.S. debt interest expense is about $1.2 trillion. So let's see how that pans out. We've got a lot of triggers and catalysts for March. It's all in our note to our subscribers. We hope you enjoyed the video. We'll be putting a few more out to talk about charts and just quick market and synopsis. But the markets are, cannot be looked in isolation, and everything is sort of pointing to a certain sort of direction. And it's all about, getting in and getting out. Take a look at Jeff Bezos, Zuckerberg, Gates, all these guys have been selling billions of stock in the last few weeks. So these guys may keep a few billions on the table for other people to take it, but they don't care. They made trillions right now in the last year and a half. So they're all cashing out. When the side is cash out, one needs to listen. We hope you like the call today, and we look to see you all next time on our next video. Have a good day. Take care. Thank you.